was going to say, if you have things you want to say about your boss, I posted a few things about mine up there. So sorry, Ray. Jim O'Connor, I'm looking at you, and it's blurry now, but it looked before like you were sitting in a tent in your backyard with a flashlight in your face. But now I don't know what you're doing there. But well, welcome everybody. Thanks for joining us. I'm glad we were able to get together. Belated Happy New Year to everybody, and I hope everybody enjoyed the holidays. We had to do this meeting because, you know, the world keeps changing around us, no matter what we try to do. So we will continue to offer Zoom. If we can do in person in February, we will. We're scheduled to do that. It is tough to do the dinners at one of the restaurants because they want a minimum of 50. They want deposits, and they're not giving the money back. So we'll see what happens come March, but going out to February, we have our spot over at Encore, and we'll go there.
Rick, you're on mute.
Rick, you muted yourself. We missed your pearls of wisdom, the last 22 words.
Did you really? I didn't even touch the computer, so I don't know what I did. I just mentioned about members in the news. Melissa mentioned that. Maybe she muted me as soon as, actually, she muted herself and hit me because I'm co-host, that's why.
I might have muted you. Sorry, Rick. I didn't do it on purpose, I swear.
Not everybody was upset, so don't worry. I do want to mention once again about us winning the 5-star council award, 7th year in a row. 2 years we've won the best council, medium-sized council in the country from NAEPC. This past year, 5-star, which is the 5th time we've won that. So basically, we're number 1 or number 2 in medium-sized councils. Medium-sized is the largest group, and there's 275 councils across the country. So we have a lot to be proud of what the board's able to put together, the speakers we have, the way we run our organization, but most of all, because you guys have stayed as members. A lot of councils have lost a lot of members in the past 2 years. It's understandable, but you guys have been very loyal and very good. And I just want to let you know, I appreciate that personally, as does the board. Because we are the 5-star winner, we do get the webinars for free. Mike Ryan runs that study group. Our next meeting is going to be next Tuesday, the 25th. Planning after all that, lifetime transfers that still work. And I thank Mike so much for what he does with the study group, but also Mike is involved with our community outreach, which is one of the missions that we have through NAEPC, and one of the things that we are graded on when we submit our application for the award. So I'll quote Mike, he is ready, willing, and available to address any community organizations on general topics of estate planning. So that our members all know, last month, the board, as part of our mission to reach out to our communities, approved donations of $1,000 each to Island Harvest, Interfaith Nutrition Network, and Long Island Cares to feed the homeless and the less fortunate during the holiday season. You may recall we made similar donations last year at the start of COVID, and we decided to make another donation this year because we are a community organization. We want to work with our community, and we thought that was the best way at this time to do so.
Do you put that on LinkedIn or social media?
Melissa, if that hasn't been done, if you could do that, I think we may have, but maybe not. But we will advertise that more. Yes, we just did it a couple weeks ago. I would say beginning of the month. So we'll make sure we get it out there. Thank you, Alan. I want to remind everybody, every member has 2 tickets available to go to the planting fields. If you remember, we had a bonus meeting, I want to say back in April or so last year, or May, and or June, it might have even have been, but we had a meeting, and we had a virtual meeting there. And as part of the deal with them, every member gets will get 2 tickets to go there at any time. Lisa has the information. She's sent it out a few times, but she'll resend it again. And we have, I believe, until August. So please use that. That's another member benefit that we have available to us. We did, as you know, we changed the sponsorships for this fiscal year. Peter Manzi is the chair of our sponsorship committee. And we broke it out between platinum sponsors, gold sponsors, and silver sponsors. Our platinum sponsors are Encore Luxury Living with Carrie Cayley. As you guys know, those of you have been to Encore and have met Carrie. Grassi Advisors and Accountants, Lisa Rispoli, who is one of the partners and the Trust and Estate Service leader. Rivkin Radler with our secretary, Joe LaFerlita. Gold sponsors, City National Bank, Peter Manzi, who serves on our board. The Bristol Assisted Living, Julie Wexler is their representative. She's the Director of Business Development. She spoke at our December meeting. And Glenmead Trust Company, Matthew DiQuolo, Matthew, I hope I said that right, who is a Business Development Director. So we thank our platinum, our gold, our silver sponsors. It helps to keep our costs down, and we're going to start doing some good things by trying to attract additional speakers if we're able to do that and to serve the community, as I mentioned. Lisa, are you on? Lisa Rispoli, are you on? No, Lisa. Okay. Lisa was going to join us as part of the sponsorship with the opportunity to say a few words on behalf of Grassi. I will move that to another meeting. So for those of you who are looking at continuing education credits, remember to submit your forms by next Monday. We'll give 2 codes or at least 1 code during the meeting or at the end of the meeting. So make sure you put that on your affirmation sheet. I think we changed the affirmation sheet a little bit, or Farrell Fritz did. So you'll see a different sheet than you might have seen in the past. You don't have to sign in and sign out, which is one of the benefits of being on Zoom. But thank you again to Farrell Fritz for making CE possible and one of the benefits that we're able to offer. Okay. Before we get to our speakers, we have an update speaker and our featured speaker, Sandy Schlesinger. I just want to make a comment about Gary Friedenberg, who passed away a couple weeks ago on January 4th. Gary was a friend, he was a mentor, past president of our council. I think he was president back in 2013. He was always available. I was chair, have been chair for a while of the nominating committee. Gary was a member of the nominating committee. Gary every year was instrumental in getting us speakers. I know every year Gary would say, do you want me to call Sandy and see if Sandy's available? Gary was a great guy. He was a great guy. And I would see him socially, although not often in the last few years because of COVID and because he was ill. But he never complained. He always had good things to say. And I'm really going to miss him. And I just needed to say something personally on that. Sandy has asked that we dedicate tonight's meeting to Gary. So tonight's meeting is in his honor for what he has provided to us as an organization, but really more as a good friend and mentor to a lot of people. He was always willing to help. So I ask you if you would just join me in a moment of silence for Gary, please. Okay, thank you. Okay, Alan Weiner is going to give us his usual update, which is filled with a lot of things that we may not know what's going on out there, or to point out some things that are important that we need to know. So Alan, if you would, please.
Just a few words about Gary before I start. So I need to condense 45 years of friendship into 45 seconds. And I'll read to you the tribute that my wife and I had published in the New York Times, and then a comment from his partner, Joe Macy. So we said in the New York Times, we mourn the loss of our dear friend and confidant. He was sincere and he was smart. And Joe Macy said, I had the tremendous blessing of being Gary's partner and friend for over 25 years. He was an individual of tremendous intellect, talent, and personal warmth. His loss is incalculable, but it is tempered by having had him as a part of my life. My sincerest condolences to his family and friends. You have lived a good life and fought the good fight. Rest in peace, my friend. So obviously, there's much more that I can say, and I'm sure that you can say. But I knew him socially, I knew him professionally, and he just had a way about him that very few people have. Okay, so these are, I do an update for another group, which I did at 8:30 this morning. I pulled out the estate stuff, and there's really going to be tidbits. If anybody wants to follow up with me afterwards, they can. So the first item has to do with the New York Cliff. And there is an article in a published by I don't know who they are. Maybe it's an investment firm called WealthSpire. And the subject was mitigate New York estate's tax cliff with smart estate planning and gifting strategies. And I'll try to give you the date. If you go into WealthSpire and you put in the keywords, you'll find it. But I don't have the exact publication dates. You can always contact me. And Sandy's going to speak more about the cliff, but there's a whole chart in there, and it shows you how you can structure a will so that under certain circumstances, you won't get caught with a New York State tax that's more than 100% of what should be paid. The next item is an obituary that was in the New York Times just maybe a week or two ago, and it just astounded me. But it's a fellow named Edward Stern. He was a CPA, and the family said, "We didn't note your death on January 14th, 1986, per a warning that presumably empty house during a funeral could attract burglars." So it took them some 30 some odd or 40 some odd years to put the obituary in, but it shows what I guess some people are thinking as to why they don't publish obituaries. The next item has to do with cryptocurrency. The topic is missing Bitcoin keys pose quandary for estates. This is kind of old news, but the reason I'm bringing it up is because there was a movie created about a fellow named Gerald Cotton. And in 1919, when he died, he left approximately $250 million locked in a cryptocurrency vault, to which only he had the key. And if you can't find that key, you don't get the money. The article that I'll mention with all the tips about doing intake on cryptocurrency is called Non-Fungible Tokens, What Every Estate Planner Needs to Know. And I picked it up from one of the tax sites that I'm in, but I'm going to give you the name of the people that wrote it. And if you Google their name, you can get this. I'll read a couple of items. It was written by a fellow named Jerry, Gerry, Beyer, Beyer, and he's got 23 points that you should consider when you're doing estate planning with an attorney, with a client. Let's try and read a couple of them. What's the first step I need to take regarding NFTs? That's non-fungible tokens. When working with an estate planning client, it is essential for you to determine if your client owns or intends to purchase NFTs. Yes, you should include a question on your client intake questionnaire to find out if the client has NFTs. You have to press the fact that he's got to tell you the truth, because I guess a lot of people try to hide that. Is there a special concern if the client purchases an NFT with cryptocurrency? Yes, many clients will purchase NFTs with cryptocurrency. That becomes a taxable transaction. As I said, there are 23 points. If you go into WealthSpire, you can find the article, or you can send me an email and I'll get it to you. For any of you that are on eBay and sell things on eBay, or you have clients that sell things on eBay, the rule for 1099Ks, which is what people like eBay and Venmo need to send to people that sell on their sites, up until the end of 2021, you didn't have to get a 1099K if you sold less than $20,000. Starting this year, if you sell more than $600, you got to get a 1099K. So it's not only for you, it's for your clients. The next item is FEMA. About FEMA, FEMA will reimburse for burial costs if the decedent died as a result of COVID-19, and if that's stated on the death certificate. For more information, just go into the FEMA site. They've got at least one article on it, and you can get reimbursed. Well, not you, hopefully, but the family can get reimbursed up to $9,000. Rick, I turn it back to you.
Thank you, Alan. Appreciate it very much. Just one thing to add. Everyone should know that there are new IRS RMD tables out there for distributions beginning January 1 of 22. The tables reflect longer life expectancies. They extend age to 120 instead of 115 under the old tables. So the factors have changed a bit, but the computation method remains the same. I've been searching for the tables and finally found them on the internet and a couple articles as well. So if anybody has any questions about it, feel free to reach out to me. I'll try to send you what I may have, but I have a lot of clients have been asking about their RMDs, and I had to wait to get the new tables. I think I read it correctly that the tables are draft, so you will use them this year, but they may change next year and become permanent. So make sure you look to the new tables. Okay, our featured speaker, backed by popular demand. I read the resumes and always try to come up with something here. So I see, Sandy, that you are a former adjunct professor of law at the University of Miami Law School. So I'm thinking we may meet there next year to do this. A little bit warmer than what we're getting here in January. But Sandy Schlesinger, founding partner of the law firm of Schlesinger, Lazatera, and Auchincloss. I don't know if I said that right, Sandy. Every year
you got Lazatera right, which most people don't. So that's
there you go. So as the old Meatloaf song would say, 2 out of 3 ain't bad. So so Sandy is a nationally recognized expert in the areas of estate and tax planning, estate administration, family-owned business planning, charitable planning. We all know that. I also wanted to point out that he's been elected to the NAEPC Estate Planning Hall of Fame. So Sandy and I were talking about baseball before this. So you didn't get in the Baseball Hall of Fame, Sandy, but you got into a Hall of Fame. So
I can tell you the Hall of Fame I'm in is not the one I started out wanting to be in.
I understand that. So, all right. Well, Sandy, we're happy to have you here again. And thank you so much for taking the time. Sandy's topic is: the only things certain in life are death and taxes. The only questions are when and how much. Sandy, all yours.
Thank you very much, Rick. Just a couple more words about Gary. Gary and I met many years ago on, not necessarily as adversaries, but not on the same side of the case. And we became friends. And he was always a pleasure to be around, even when his health was failing. Just a real hero of a guy, as far as I'm concerned. He had one flaw, which I have the same flaw: go New York Giants. I don't think anybody loved the Giants. Well, nobody loves the Giants right now, but I don't think anybody loved the Giants as much as Gary did. No, Ray, you sort of love them a little bit. So again.
No, I do. In fact, he was also, I think, a diehard Yankee fan like you,
Yes.
Sandy. So it is what it is. You guys survived. It's all good.
No, but again, I'm glad that we're dedicating tonight to Gary. I think he would appreciate it. It's very funny because I was saying in the chat room, I've been doing quite a bit of lecturing and getting used to doing the Zoom lectures. In fact, I'm almost starting to like them. in a sense, they've been more successful than other lectures because it's so easy for people. They take an hour, it's an hour. It's not an afternoon, it's not an evening, just for the record, I've chaired PLI and NYU this year, and they had the biggest crowds ever and done by Zoom. So Zoom, I think, is here to stay. Plus the overhead on Zoom is much less. So don't think it's going away. The problem is when I prepared the lectures for September and October, I said, and when Elise called and said, we want to do, the Estate Planning Council of Nassau, and it's always my pleasure to say yes, and I always do say yes. I said, oh, it'll be a piece of cake, right? I mean, I'm already prepared. And therefore, well, almost everything I'm lecturing on tonight, not everything, but a lot of it is stuff that was not there in September and October. Of course, President Biden really did pull the rug out from all of us on December 3rd, when, he basically, and we'll get into that in a few minutes, when he basically took most of the transfer tax issues out of Build Back Better. In fact, I spent the weekend of December 3rd, because I remember correctly, it was a Friday, and we had done a lot of spousal lifetime access trusts. And I had to call a lot of clients, say, it looks like you're not in trouble anymore. But remember, you only have to December 31, 2025, or something may happen then, if not before. So what I suggest you do is you sign your slat and don't fund it. And sure enough, most people did not fund it. I'm sure many of you have had the same experience. I also had told my entire staff in early November, no vacations between then and first of the year, because I thought we were going to be busy as hell. Now, we were busy, but nothing like I anticipated, because there was no reason to do anything on an emergency basis. So it's extremely relevant. And as many of you know, I like to start with a joke, and it was, it's very funny. Will Rogers and Mark Twain, and that's a long time ago that these people are gone, but Will Rogers' comment is, no man's life or property are safe while the legislature is in session. I mean, is that right on? Is this as if it was last night? Okay. And of course, Mark Twain said, there's no distinctly Native American criminal class except Congress. And those quotes could have been taken, as they say in Law and Order, ripped from the headlines. Again, IRS, and I'm going to get into that in a few minutes. What IRS is doing now, or more accurately, what IRS is not doing now, is something I do want to spend a few minutes on. But nothing's going on at IRS correctly. But believe it or not, they took the time, this came out November 18th, that they're changing the policy on retention of old estate and gift tax related returns. Currently, they hold these returns for 75 years. Effective February 11th, 2022, you will no longer be able to request returns that are older than 40 years. This is what the service had time for, right? I mean, to me, it's just amazing that, what's going on. I'm going to ask people a question about that. The report, the daily tax report in Bloomberg on January 13th had, this is the annual report to Congress, details before the filing season opened. IRS for 2021, okay, only returned 11.4% of returns. Phone calls, I'm sorry. 11.4% of phone calls are returned. Now, this is not telling you that once you got through, how many hours you had to wait on the phone and whether you got the answer to your question. So it's 11.4% got through in 2021. In 2019, 28.7% got through. I mean, this is just unbelievable. I mean, as far as the service's inefficiency and lack of responsiveness is concerned. On the other hand, in fairness to IRS, in 2021, they received 275 million phone calls. Is that unbelievable? I mean, and in 2019, they only received 99.4 million phone calls. So the situation at IRS, I'm going to ask the question, has anybody in the room, in the chat room or Zoom room, I guess it's called, has anybody had IRS not process a 2020 return? Has anybody had IRS not deposit a check? Come on. Almost everybody I'm speaking to. Has anybody gotten a levy notice from IRS on a return allegedly not filed and you know you filed it? Well, what apparently is going on, and it's a real problem. I've had this in several estates where the estate tax return was filed, the payments were made, and we got notices. And what's going on is, well, two things. One, the clients blame you. But it's not. This is something, and I've been doing a survey about it, not a scientific survey, but I've been asking people about it. It's a real problem. And I think we have to be more careful as professionals. As late as yesterday, when I had my staff meeting for the firm, I announced that if you have a return due, don't wait till the night before. Don't wait till the week before. File it a month early now. I'm dead serious. I'm dead serious. If there's one piece of learning we all come out of tonight with, I think that's the one. Because, I know, especially lawyers and accountants, we love deadlines, don't we? But most of our deadlines we create for ourselves. And it's a real problem. And there was an actual on the ACTEP web. It's funny if it's not happening to you or me, right? Okay, one of the members of ACTEP sent around this email. We prepared a federal estate tax return only for portability reasons, and it was due last Friday. We placed it in the FedEx box outside our office building 2 days earlier. We couldn't find the package in the FedEx system today using the tracking number. After several calls with FedEx, we learned that the driver responsible for pickups reported the box had been tampered with the day we dropped the return into it. Okay. It's the best course of action to get the client to sign a copy of the return. Oh, okay. So what happens? And now I'm asking you a question. How do I solve my problem? Anybody know? Now, assuming the return was filed either 9 months, 2 days short of 9 months, or 2 days short of 15 months after death, right? Well, guess what? This guy isn't in trouble. Why? A return filed solely for portability purposes, you can get up to 2 years from death to file it. So he may not have been in trouble. His solution was that he was going to send in an explanation to IRS what happened. Should that be sufficient? Yes. But my wife was also my law partner, as many of you know. She's very smart. And I tease her sometimes because she's very cautious and very careful. She will not file anything without taking it physically to the post office. Okay? Therefore, what happened here, you should never put it in an unsupervised FedEx box. You have no proof of filing. You ought to go to the post office, file it, and get return receipt requested. And I preface this by what I have been told from people who really know what's going on. There are trucks full of unopened tax returns, trucks full of them. And I think this is a very serious problem for people right now, because remember, in this type of situation, you're guilty till proven innocent. So be very, very, very careful. Another thing, and this is what's going on is I don't know about all of you, I'm finding it very difficult to practice efficiency. We're practicing efficiently. We're practicing remotely for the most part, but getting something done is pretty hard at this point. Now, again, without explanation, they let the remote notarization and execution of documents, especially wills, lapsed. It happened when Cuomo fell out of favor with the state legislature. It lapsed. Now, Governor Hochul has signed a law on December 22nd, 2021, permanently legalizing remote notarization. Again, maybe the most important act in her governorship. Okay, but does anybody know what the glitch here is? There's two. One glitch is because of the nature of what she signed, it has to have 180 days rest before it comes into law. So remote notarization will not come back until June 20th, 2022. Okay, June 20th, unless Governor Hochul goes to the legislature and asks for dispensation. So if anybody wants to write a letter, I don't know about any of you, but getting things notarized has been pretty difficult. I see Ray Radigan smiling about that. I mean, it's a real problem. But did you get the second part of my comment? It does not apply to remote witnessing of wills or anything else for that matter. Okay, it's notarization. That's all it says, unless I'm misreading it, unless they didn't mean what they said. It's only notarization. So again, a tremendous trap for the wary.
Sandy,
Now,
I read an article the other day where Hochul, the new notarization of will notarization statute, does not involve what the process was where you watched them do it and then they had to give you back the
no,
original.
right, the one day process? No, that's
Yeah,
not.
what I read was that the process they're going to have is not going to involve that. It's going to be an electronic signature system. And the report I read was that she is going to reinstitute the old notary system, you know, having to exchange papers. That way, but that like Cuomo did with the executive order until the new law takes effect.
I've not seen anything
So
on
you may
that.
be able to do it as soon as next few days.
That'd be
If
great.
I find it, I'll send it on.
I've not seen anything on it, and my reading on it is current as of this morning. So, I mean, it's, again, it's a real, I don't know about anybody else, getting a document executed these days is not fun. And it's a real problem, and clients are getting much more aggressive about wanting to come into the office and stuff like that. So it's been a problem. But just for the record, 40 states allow remote online notarization. So I'm sure many of us had, I know I've had notarizations in other states. Again, you got to be very careful. You got to be very, very careful. I mean, I hate sending documents out to be executed not in my presence. And no matter how detailed the instructions are, most of the time they come back with a problem. They do, and they really, really do. So again, just another hint. Another thing of recent vintage, extension of time to file tax returns because of Hurricane Ida. In many jurisdictions, it's been extended from January to February 5th, from January 3rd to February 15th. Now, be careful. It's not true of every county. I see Ray smiling again. It's not true in every county. You better check. What I suggest you do is you call, because you better check which are on the affected counties. It's not every county. So, meaning just even in New York, and it's not, and you know, it's in other states as well. It's New Jersey, Connecticut, Pennsylvania, Louisiana, Mississippi, but not necessarily the entire state. Okay, so you better check that your county is one of the covered counties. Okay. Let's talk for a few minutes about, as a lead into the discussion about the Build Back Better bill and whether there will be, and the nature of the legislation, if any. I would want to bet, at least up to now, that we would not have had a bill effective by January 1st, 2022. It just was a feeling. I didn't make the bet, but it didn't happen. It just didn't feel like it had the urgency of certain other bills. Now, I know one of the things, and most people on this here and myself, we do this a long time, and IRS or the Congress likes to give us a Christmas present usually and ruin my Christmas. The legislation comes out somewhere between Christmas, between Thanksgiving and New Year's. It didn't happen this year. I'm going to focus, not exclusively, but almost exclusively on the transfer tax system, meaning gift, estate, and GST tax. All right. And I'll give you one very good example of why I thought this was not going to happen. And many of you remember that in the original bill, basically they would abolish through the back door grantor trusts, right? And grantor trusts, most insurance trusts are grantor trusts. The vast majority of grantor trusts or not grantor trusts, of insurance trusts, of grantor trusts. I'll never forget a million years ago when I was at Shea and Gould, and I was chairman of the trust and estate section of the New York State Bar in then a year that what I'm going to talk about. And the state bar, they were going to change the New York State right of election. It used to be in New York that you could leave your spouse's share in trust and qualify to satisfy the right of election. Well, there was a huge movement to change that to what the law is today. 1/3 outright, unless you have an agreement or a waiver. And that's indigenous to New York. And I, as chairman of the trust state section, was charged with trying to keep the law the way it was. Okay. And we worked like dogs. We went up to Albany. We met with the legislature. We got nowhere. And bill was supposed to be voted on a Monday morning. And on a Friday night, when I was at Shea and Gould, one of the partners who worked in government relations, a polite word for lobbyist, comes in and says to me, his name is Bob Bishop. It is Bob Bishop. And he comes down to me, he says, Schlesinger, what's this right of election statute? And he speaks with it out of one side of his mouth. What's this right of election statute? And I tried to explain it to him. I'm not sure I succeeded. But he said, is there something about life insurance in there? And I said, yep, they're going to make life insurance subject to the right of election. He said, no, they're not. And guess what? The bill passed on Monday. Life insurance is not included in the right of election. I learned a very big lesson that day. And that's when I knew the grantor trust rules were not going to happen because the insurance lobby had not sung. And it happened. And so it's a very good lesson to learn. And so that's one of the reasons, they could have changed the grantor trust proposals to specifically exclude life insurance trusts. But I know me and many other people were advising people to use up their unified credit by funding the life insurance trusts. In other words, we call it an irrevocable life insurance trust. It's a regular trust. It just happens to hold life insurance. So rather than paying premiums and using up annual exclusion, if you had unified credit exemption equivalent that you were likely to lose, use it up there, assuming the trust is well drafted and accomplishes your purposes. But again, that's when I knew the bill was in trouble, at least that part of it was in trouble, and I was correct. Having said that, you've got to put the transfer tax system in perspective. Everybody in this room earns their living based on the transfer taxes, one way or another, whether it's life insurance, whether it's banking, whether it's investing, whether it's accountancy, whether it's law. And therefore, it's important to us. It's not important within the tax structure, though. It really isn't. And I'm going to give you some statistics. If I can find them. Okay. And the latest statistics are for 2019. Okay. The number of state tax returns filed in 2019 decreased by 60% from 15,191 in 2010 to 6,409 in 2019. Before COVID, 2.5 million Americans die every year. 6,409 returns. All right. Now, why did it decrease that dramatically? Because the unified credit went up dramatically. Of the returns filed on estate tax returns, California had the highest number of returns filed in 2019, followed by Florida, New York, Texas, and Illinois. Okay. The top states per 100,000 filing returns, I'm going to get this wrong, I apologize. When the number of state tax returns filed by adult population per 100,000 was considered, the top states for filing are Wyoming, District of Columbia, Florida, California, and South Dakota. Not that many returns are filed. Not that much money is collected. It's not that important. Much more important to a congressperson or a senator from any of these states is SALT, the state and local tax. And in the proposal, that's what they're going to go to the wall for. Nobody's going to vote out a senator based on the transfer tax. That's why what Biden did was very, very smart. He took the transfer tax stuff out of the bill. Why? Especially the unified credit exemption equivalent. Why? It's going to expire December 31, 2025 anyway. Why alienate anybody? Okay, now let's go to that for 1 minute. Is it going to expire? Well, we were talking in the chat room before doing the program. Well, guess what? You're going to have at least 2 Congresses. You're going to have at least 1 presidential election. Things that can change. I mean, if the vote was today, it looks everything I heard on the news today, Biden's approval rating, it looks like, and traditionally, the outer power party captures at least one house of Congress, at least one. And so, again, we can't predict. So Sandy's advice right now, you don't have to cancel vacations like Sandy did, but what you really should do is use your unified credit. Use your unified credit while you still have it. And again, one thing is clear, there's not going to be retroactivity at this point, but the longer you go into 2022, the longer you run the risk of possibly losing your exemption equivalent. Now, again, the problem was, and it will be, and we'll get into inflation adjustments in a minute, but the exemption amount being what it is, I had a lot of clients, I'm sure each of you had this, I want to use up 3 million of my unified credit, right? I can't use 11 million or 22 million because I don't have the kind of money or I don't want to give up the kind of money, all right? Well, the problem with that is, and it's a very serious problem, is if you use the lower levels, you've accomplished nothing. Because even if they went back to 2010 index of inflation, your exemption would have been between 6 and 7 million. So if you're going on the low side, especially between husband and wife, it wasn't worth the chase. And no proposal that I've seen at least, said we're going to do away with the unified exemption equivalent completely. So again, part of that was the same issue. So again, don't expect congressional help here on the transfer tax. It's not that important except to us. Okay. And again, having said that, I think what's very important is I did not, and I'm going to ask a question. Did any of you send out client letters about the tax bill, the Build Back Better? No, I mean, some firms send out a monthly, like Proskauer sends out a monthly letter. Hodgson Ross sends out a monthly letter. I voted not to send it out, and I got complaints from some clients. I said, I don't know what the law is going to be. All I'm going to do is confuse you. And again, turned out to be correct because no letter should go out. On the other hand, you can't ignore what's going on. Okay, a couple minutes on the Build Back Better bill. The significance of the bill is what's not in it. Now, again, nobody wants to know 2 things, what's in sausages and how tax laws are made, right? And so therefore, the fat lady has not sung here yet. There's going to be horse trading. The president said yesterday, and this is what he should have done in the first place. He should have had a bunch of little bills, the same little, big little bills, like the infrastructure bill passed because it was focused in one area and you couldn't dare vote against it. What should have been done here is a bunch of little bills. And the president alluded to that yesterday. So therefore, something could happen in the transfer tax area as a trade-off. Because as I said a minute ago, salt's important. The salt proposal on the table is $80,000 expiring in 2031. That's a little bit sinister, okay? And there could be an income cap on it because Congress seems to love the number $400,000. You're rich if you earn 400 or above. You're poor if you earn less. So the problem is that salt will be an issue. On the other hand, you still can have transfer tax legislation. Nobody is barring it, and it can end up there in the last minute. So therefore, advice again, use your unified credit. If you have a client who fits in the category of being able to use it, use it. Do a spousal lifetime access trust. Okay, everybody's familiar with them, right? It's now the vehicle of choice. 2 problems with slats, and I'm not a lecturer on slats. One, I create a slat my wife is a potential beneficiary. That way I sleep better at night, knowing if I need the money, I can access it. But the last thing you want to do is take that money, because then you've wasted unified credit, right? So therefore, though theoretically I can do a slat and do, and I make my wife a discretionary beneficiary, make sure I have a third-party trustee, make sure I don't have reciprocal slats. My wife does one for me, I do one for her. Be very careful that if the money for hers comes from me to go in the trust for me, that you may have a 2036 problem, a retained interest. So therefore, if you're going to transfer money to your spouse, do it far in advance and don't have it linked. But preferably she should have her own money, I should have my own money, and we can do slats that are not reciprocal, meaning they are slightly different from one another, all right? And the difference could be the name of the trustee. It could be whether one's subject to an ascertainable standard or not. It could be anything you want to have different beneficiaries, that one have a charity in it. Okay, the two problems with SLAT, or two of the problems with SLAT. One, I get divorced. Okay, that's a real problem. I get divorced. And therefore, I don't want any distributions made to my wife. And if distributions are made to my wife, I assume she's not going to turn it over to me. So that's the problem. All right. And if we're divorced and she's nice and we're not nasty hating each other, any distribution that she turns over to me would be a non-marital qualifying gift, correct? We're no longer husband and wife. So that's a real problem with the SLAT. The second one, she dies before me. She dies before me. So that's a real problem. So the SLAT is not a panacea. It's not a cure-all. It's a wonderful tool, but be careful when, where, and how you use it. Just going for a couple of minutes, what's not in the tax bill, in the Build Back Better bill, excluded items were no change to individual ordinary income tax rates for taxpayers with incomes below 10 million. I'll get into that in a minute. No change to individual capital gains or qualified dividend tax rates for taxpayers with income below 10 million. A couple of minutes to get into the surtaxes. No change to estate, gift, GST tax exemption amounts or rates. No change to step up in basis rules or deemed realization rules at death. So you still have your step up in basis. And that's critical because what Congress was doing and probably still is doing, they learned their lesson that it'll change in 2026 without doing anything, or just that not many people are affected by the transfer tax system, and they're not, all right? But the step up in basis is critical, and I'm going to spend a couple of minutes on that. And by the way, it's not a step up in basis. It's a new basis at death, especially the way the market was today. Many people may not have as much gain as they thought they had. So it's a new basis at death. And that means it could be a lower basis or a higher basis, but generally assets have gone up in value over time. Therefore, they're worth more at death than they were when I paid for it. And it's not a capital gain. It takes the value at date of death or alternate value. That's good. Why? Many, 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 many more people would be subject to that tax than the transfer tax. Because anybody who bought a house in the 70s and still owns it today, if there would be no step up in basis at death, all right, it would be a problem. They would not be subject to estate tax because most people aren't worth 11 or 22 million or 12 or 24 million, correct? So therefore, you're much better off dying with the house, getting a step up in basis, and you avoid the capital gains tax when your executor sells the house. So that's important. But also on the table under the BBB was not just no step up in basis, death would be a realization event for that capital gain on that house. Now, there were exceptions, exclusions, and stuff like that. This was very serious stuff. And it's not in BBB as of today. No change to the grantor trust rules. I already mentioned that. And again, nothing says they can't change the grantor trust rules and carve out an exclusion for life insurance trusts. No change to valuation discounts. I know somebody is around here. I don't see him. Is he still here? Somebody was here from Empire Valuation. So the no change to discounts. By the way, does anybody get a feeling that something sounds very familiar to you? This was all in the Obama Green Book. Almost everything here is not new. There's nothing new under the sun. And therefore, many people have said, and I usually do lecture when a new green book comes out, and they say, why are you wasting our time? It's not even in a bill form. Why? Because once somebody floats it out there, they remember it. And a lot of this stuff was in the Obama Green Book. Okay.
Sandy, can I interrupt you for a second? I'm
Sure.
sorry.
Sure.
I'm just to invoke Gary here. I'm going to give the halftime code instead of the midway code, thinking of the Giants. So the
Yeah,
code,
but then you'll be off sides.
yeah. No, it'd be a negative number actually. So the halftime code is 917. I'm going to put that in the chat.
Okay, 917. How much more time do I have?
I don't know, a couple hours. No, let's say 20, 25 minutes, if that
Okay.
works for you.
Sure. Okay. Another thing that was not in the Biden final proposal, what's called the framework, and then the updated framework is what this is called as of November 3rd. I'm sorry, as of December 3rd. No change to the carried interest rules. Now, I know that's not a trust in estates issue, but that's a very important issue. The treatment of carried interest that are held more than 3 years are treated as capital gain rather than ordinary income. And when you put this together with the change possibly in the income tax rates, both capital gains rates and ordinary income rates, very significant omission again. So what is left in the bill? And I don't want to spend too much time on it because I don't think anybody has a clue what's going to happen. But what they're really doing is putting a surcharge on the income tax of what the government deems wealthy income earners. They want to tax income. And so the first tier is going to be a surcharge of 5% to individuals with modified adjusted gross income in excess of $10 million. Okay, a 5% surcharge. The threshold is the same for married couples and single taxpayers. But for an estate or non-grantor trust, the 5% kicks in at $200,000. Keep that in your head, okay? There's a tremendous antitrust. I don't mean antitrust like IBM owning everything. I mean antitrust sentiment in Congress. The low thresholds to highly taxed trusts is just, in my opinion, a misunderstanding. Okay, that's the first tier. There's a second tier, which would be an additional surcharge of 3% to individuals with modified adjusted gross income in excess of 25 million. Okay, same surcharge for married couples and single taxpayers, and for non-grantor trusts or an estate, that threshold is only $500,000. So if you're talking a trust, you have an 8%, okay, increase in tax on that. And a good example is if the bill had passed and there would have been a tax liability, if you had a client with a trust with $1 million in capital gains and $100,000 of ordinary income, okay, $1 million capital gain and $100,000 of ordinary income. If it was 2021 and the old law was in effect, your tax liability on that total amount would have been $276,606.40. We're not talking huge numbers here, are we? We're talking $1.1 million, and a good most of it capital gain. In 2021, it would have been $276,606.40. In whatever it is, if BBB passes in the format that it was in, the tax on that trust would have been $339,551.40. $339,551.40. And I'm not including, okay, I'm not including state and local taxes. I am including the net investment income tax, which in both cases, the 3.8% would have been 41,288.90. In other words, if this ever does become law and these concepts remain, we got a serious problem, because trusts are going to be very inefficient vehicles. And in drafting, look, trusts that exist, probably there's not much we can do about, maybe decant in given circumstances, but be careful. Be careful, because obviously the congressional dislike of trust is pretty significant at this point. Okay. Let me go to state estate taxes. And this is very interesting. Okay. True answers. How many of you have had clients move to other states for tax reasons? Come on. Come on. Everybody has. And the answer is, I hate Florida personally. I hate heat, I hate humidity, and I'm scared stiff of alligators. But having said that, people have moved to states in order to avoid income and estate taxes, correct? I've lost clients. And what happened, many of them over the last 2 years have said, you know what? I'm down there 6 months a year, might as well stay. Seriously. I mean, and a lot of them haven't come back. Now, some of them came back screaming and begging, please let us back to New York. And of course, our brilliant government in New York increased income taxes while people are leaving. I mean, that'd be one of the dumbest things in the history of government. But, now they have huge surpluses. And the governor says yesterday that she doesn't picture any deficits for 5 years. I mean, so that's it. But what I'm trying to say is, guess what? You don't have to go to Florida anymore. You don't have to go to Alaska anymore. You don't have to go to North Dakota anymore. 9 states do not have an individual income tax. All right? 9 states do not tax non-grantor trusts. Those states are Alaska, Florida, Nevada, New Hampshire, South Dakota, Tennessee, Texas, Washington, and Wyoming. All right. So you got a good choice there. You can go skiing, you can go to the ocean, you can go, tap a tree. I mean, it's not that you really have to do it. I had one client during the pandemic move from Vermont to New Hampshire because Vermont has an income tax. New Hampshire does not. He moved. I think one house is 20 minutes from the other, but that's beside the point. But it's very easy now to move to avoid the income. And this is exactly what is happening. So are your clients moving out to avoid the estate tax? I'll get to that in a minute. Are your clients moving out to avoid the income tax? Yes. Yes. And what is moving out are people, what's his name? The hedge fund guy who moved from Connecticut to Florida and moved his entire, Carl Icahn. He moved his entire operation, and any employee who did not move to Florida with the company was fired. So it's not just taking his money out of the state, it's taking anybody who works for him out of the state as well. And so, but now, so I remember, most people pay income tax. Going back to my earlier conversation about how many estate tax returns and gift tax returns there are, not that many people are subject to the estate tax. They're really not. So now let's go to the state estate tax, my roll call of the states, which if I can find it. New York State. One second. Now, here's another case. Now I'm going to talk about state estate tax. And this is a very interesting thing too. Only 18 states now have a state estate tax or an inheritance tax. 18. That's pretty interesting, isn't it? Meaning, what was it now? 50 states plus the District of Columbia. So therefore, it's not very hard to find a state that does not have an estate tax. And when we go to the list, my 18 includes some states that only have an inheritance tax. And almost invariably, An inheritance tax does not apply to a spouse, issue, and charity. It's usually non-related people and collateral relatives. So therefore, your estate tax issue really isn't it's your tail. Your dog is the state income tax now. And I think it's a real flip-flop. So let's go through the states and leaving New York to last. And this is the 2022 exemption. The chart is in your outline, but I want to go through it. Connecticut is the only state with a gift tax. And it has a gift tax. I know as a fact, the governor wanted the gift tax repealed, and he is a Democrat, but the legislature did not want to repeal the gift tax. I think it puts Connecticut at a huge disadvantage, but again, it is what it is. No other state has a gift tax. So therefore, making gifts with the huge federal exemption of 12,060,000, right? 12,060,000. Let me double check that. Double check that so I don't misquote. Yes,
That's right.
12,060,000 is correct. That means 24,120,000 between spouses. It's not an issue for most people. It's less than 2% of the population. So you got to focus somewhere else. And the state estate tax is an issue for the people that with the states that have it. And I'm trying to show to you empirically that people can move out and without much hardship. Okay. Now, Connecticut has a gift tax. It has an estate tax. Its exemption in 2022 is 9.1 million. So that's, and this is very interesting. It is supposed to conform to the federal in 2023. Okay. Now, if they decrease the federal exemption, it could be that the Connecticut exemption now is greater than it will be in the future. You don't know. You don't know. You just don't know your answer to that. But the issue is it's 9.1 million, but Connecticut did something very smart. What they did is they put in 2019, they put a cap on the estate tax and the gift tax. Okay. In other words, to keep their hedge fund trillionaires, what they did is beginning in 2019, there's a cap on the Connecticut estate and gift tax of 15 million. So meaning if I have $1 billion, my maximum Connecticut transfer tax is 15 million. That means you don't hit that number until you have approximately $129 million estate. And again, if I'm a billionaire and I love Greenwich, guess what? I'll pay $15 million for the privilege of not to have to live in North Dakota. So that's the issue with Connecticut. And so again, the gift tax is the problem in Connecticut. District of Columbia, 2021, I don't have the number for 2022, exemption 4 million. Hawaii, 5,490,000. Iowa has only a separate inheritance tax. Kentucky, only an inheritance tax. And remember, close family does not pay an inheritance tax. So look how few I'm coming down to is the number of states that really have an estate tax. Maine, exemption 6,010,000. Maryland, 5 million exemption. Massachusetts, only 1 million exemption. Minnesota, 3 million. Nebraska has a county inheritance tax only. I found out what that was. It's a state inheritance tax, but it's collected by the county. It took me 20 years to find that one out. New Jersey only has an inheritance tax. And many of you here will remember the day Governor Murphy was elected, they said New Jersey has its estate tax back. Well, he's just won his second term and it only has an inheritance tax. It does not have an estate tax. New York, I'll get to that in a minute, but the exemption for this year, the exemption for 2022 in New York was originally wrongly reported. The correct number is 6,110,000. 6,110,000. And let's go to one other thing here. New York does not have portability. So keep that in mind when we get into more detail in New York. Only 3 states have portability. And I'm assuming everyone knows what portability is. The wife or husband inherits the unused exemption of the first spouse to die. And federally, there's portability. Hawaii, Delaware, and Maryland have portability. No other state has it. New York does not have it. Connecticut does not have it. That means if the spouse doesn't use this exemption on the state level, that spouse loses the exemption. Okay. Oregon, $1 million exemption. Pennsylvania, only an inheritance tax. Rhode Island, an exemption of $1,648,111. Vermont, $5 million. Washington State, $2,193,000. So again, what's really going on here is that the state estate taxes is becoming much less of a factor. Now let's turn to the beautiful state of New York. New York's exemption is $6,110,000 for 2022. No portability, but as Rick mentioned, we have a cliff tax. And that means if you live in New York, you might as well jump off a cliff, right, Rick? I mean, that's really what it is. If you go over a certain amount, and I'll give that to you in 1 minute, you are subject to New York state estate tax from $1. So in 2022, you have a $6,110,000 exemption. But if you go 5% over that, which means an additional $305,500, 3055, meaning a total of $6,415,500, your exemption is zero. Your exemption is zero. And this is, have any of you had a problem with going over the cliff inadvertently? No? I wake up with cold sweats because, you know, not every will has been redrawn since the new not so new New York tax law. And when you carved out your unified credit, a lot of people have not drawn new wills. And so since the 2017 Act, our drafting is going more in a good family situation to disclaimer trust from unified credit trust, because that way you had the flexibility. Like, we have no idea what the law is going to be in the future because some track the federal, some don't track the federal. And so what you're going to have is you may inadvertently go over that 6,110,000. So the problem is, and we've had the problem, we've had the problem. And so you've got to draft flexibly in the future. The problem is when you have wills that that have not been changed since New York changed the tax law. And that's a very, very serious problem. Yeah, I know. I didn't want to forget this. And I want to give you an example of how serious this is for New York. There was an article in Cranes on December 10th. New York's share of US millionaire earners dropped by nearly 4% between 2010 and 2019. The decline came after 2010 legislation that raised the highest income tax rate to 8.82% from 6.85%, and before legislation of 2021 raised the rate again to 9.65%. That's New York is losing money because of the people. And the total number of federal income tax filers earning more than 1 million grew 96% between 2010 and 2019, but New York's share grew by 54%. So we're behind other states. Money is going to other states, and it's a very serious problem. One last thing on the New York cliff tax, and this is serious. Any gifts, now we don't have a gift tax, any gifts though made within 3 years of death come back in to compute whether you fell off the cliff. That's awful, because I had a situation, I had 2 clients, husband died, wife was fine. A year after the husband dies, she finds out she has terminal cancer. She'd gone over the cliff. She couldn't get off the cliff because the gifts came back. The gifts came back. Now, very importantly, if you own real estate outside New York, it is not subject to New York state tax, New York estate tax. That can get you away from the cliff. It does not go toward the cliff. But New York is a huge trap. Our clients don't change their will with every change in the tax laws. And so just be really, really careful here with New York. Okay, I have a couple of minutes left. I do want to cover two things. One, a practical issue, and number two, inflation adjustments. Anybody have $67? Is that the dumbest thing you've ever seen? I'm going to pay money to get worth. I intentionally put it in about IRS not returning phone calls, about IRS not processing returns. And now I have to pay $67 for a closing letter? I mean, I can't make this up. You know, when I teach in the law schools and I put something like this on the exam, the students think I'm giving them red herrings. If I gave them red herrings, it wouldn't be as bad. But this is, I'm sure all of you know that you have to pay a $67 processing fee in order to get a closing letter. And they're also saying now, and that's effective, was effective October 28th, 2021. And you have to do it by pay.gov must be used to pay the fee. So estate tax closing letters will not be issued over the phone. You cannot call IRS on this anymore. Okay. So you got to pay $67, pay it through pay.gov, and you can't call up. Now, the next thing is they telling you, don't ask for your closing letter until 9 months after you filed. Don't even ask after you file, 9 months after you file. Serious, folks. Why? Guess what? Your returns due within 9 months. Many returns go on 6-month extension. You're not supposed to ask for a closing letter for 9 months. By the way, we're not saying you're getting a closing letter in 9 months. They're saying don't ask for 9 months. That means when you tell your client that you can't make distributions in certain cases for up to 2 years, are your clients going to be happy? No, not happy at all. And so therefore, what would used to be pro forma is, and one of the things I loved about it, the estate tax return, it's not like a normal tax return where, you know, you wait your 3 years or your 6 years, or you're really scared if there's fraud, you know, you got to wait and pray that you don't get a letter from IRS, 3 years, 6 years, whatever, on an income tax return. On a gift tax return, it's even worse because you're open unless you've made full disclosure, and nobody really knows what full disclosure is. So, but an estate tax return, what used to be so nice, right? You wrapped it up with your little bow and you got your little closing letter and you were a happy camper. Now, I don't know what you're going to do, especially with the new stricter procedures on releases of lien. If you're going to sell some real estate, you know, IRS, unless you've paid the tax or made other arrangements for paying tax, they take the money from the sale of the property. So again, a kindly, gentle IRS. In the minute or two I have left, I don't want to skip inflation adjustments. I'm not sorry, not inflation adjustments, because I think I've more or less covered that. Oh, no, I'm sorry. Very important. The biggest event of 2022, the annual exclusion is it has gone to $16,000. So the annual exclusion finally went up, adjusted by inflation, to $16,000. Again, if you want to track the history of the annual exclusion, it should have gone up a lot more. It should have gone up a lot more. Again, the annual exclusion is something that people overlook. I've had too many people want to do slats and they haven't used the annual exclusion. So make sure they do it. One piece of advice, do it now. Do your 22 annual exclusion gifts now. If you die, you lose it. So if you die during the year, you lose it. Therefore, you should use it instantly. And again, if you did it at the end of the year of last year, you better make sure the check cleared collection before January 1st, because if that check was deposited after your son finished his ski trip and couldn't put the check in the bank till January 2nd, that's a 2022 gift, not a 2021 gift. The last area I want to talk about for just 2 minutes. I have yesterday, IRS came out with the February 2022 applicable federal rates. And I have the applicable federal rate for the last several months here with me. It's going up, folks. It's going up. Is it still very low? Yes. The actual federal rate for February 22 is short-term 0.59. In January, it was 0.44. In November, it was 0.22. Okay, so it's almost triple from November. The midterm rate, by the way, the short-term rate is not over 3 years, just so everybody's on the same page. The midterm rate is over 3 years, but not over 9 years. For February 2022, 1.40. February 2022, 1.40. I'll take you back to November. It was 1.08. For long term, which is over 9 years, for February, it's 1.92. And November, it was 1.86. Okay. Now, therefore, make use of this. And I think we're all pretty well convinced that if you make a few changes, if you have old notes that have high interest rates, you can restructure the note to take advantage of low interest rates. And too few people are doing that, because it looks like interest rates for the foreseeable future are going to go up. And by the way, the 75/20 rate for February is 1.6. For January, it was 1.6 as well. And for November, it was 1.4. So it's clearly going up. Hey, if you have a tax break, take advantage of it. And I think I'll stop on that note. Thank you very much.
Sandy, thank you. Thank you. We really appreciate it. I was trying to think of all the analogies to use. You could go into overtime or extra innings or whatever, but it was. And does anybody have any questions at all? Either put it in the chat or speak up. We'd love to hear from you. Any questions for Sandy at all?
I see two chats here. I don't know if they're questions though. Sandy, oh, okay, that's just a personal note from Gary. Thanks, Gary Schreider. Thank you, Gary. Oh, the halftime, the other one's the halftime code. Okay, I don't have any questions.
Well, Sandy, thank you. We
My
always, we love to see you and love to hear from you.
Hey, Rick, I have a quick question.
ahead.
Sandy, you know, we live in this polarized Washington environment right now. And I'm blaming both sides. I'm not taking sides. I'm on both. How do you plan in this environment? I mean,
Retirement's an idea. You can't. And, you know, many of you heard me say this, I am running for president. And during my 8 years, the only thing I pledge, there will be no changes in the law at all. Good, bad, or indifferent, it won't change. I mean, one of the comments is, and this is a true story, I use it as a joke now, but a lawyer who was toward the end of his career, and the 1986 tax law came out, and he says, why does Congress keep repealing my knowledge? And I've now reached his age, and I'm starting to take it personally also. You know, another thing is somebody said about suicide and contemplation of tax reform. I agree with you. I think one of the things that really is the lack of consistency. I mean, it's great that the Build Back Better, at least in our area of practice, didn't pass, because most of it would have been unmanageable to deal with. And again, nobody says a lot of this isn't going to become the law anyway, somewhere down the road. On the other hand, I agree with you. I don't know how to plan anymore. I was just saying, is I went from unified credit trusts to almost exclusively disclosure trusts,
Yeah.
because that's the most flexible thing in the world. But you got to understand, the disclaimer trust isn't the foolproof thing, because guess what? How many people have spoken to widows or widowers who refuse to disclaim? I don't feel secure. I hate my, or the husband has children or the wife has children by a prior marriage. I mean, it's a nightmare. It's really a nightmare planning these days. And no, it's just that bad. By the way, Rick, you forgot the second code.
Well, I was about to do that. I just was waiting for you, but I guess I'll do it right now. Push the button. Anybody who needs to jump off, so. There we go. Well, Sandy, thank you very, very much.
My pleasure, and take care, everybody.
We really appreciate it. Just remember to please submit your forms to Lisa by Monday, the 24th. Our next meeting is going to be February 17th. We hope it'll be in person, but God knows. But it's going to be Jennifer Hillman and Joe LaFerlita. And our topic's going to be, can a New York settler create a silent trust? So looking forward to that. I would tell you all to get home safe, but I'll say get to the kitchen safe and don't trip. So
Take care, Sandy.
Take care, everybody. Be well.
thank you, everybody.
Thank you.
Great seeing you.
Good
Be
night.
well.
Good night.
Be well.
Hello. I know, you think you if it didn't know that, you think I'd pick it up? I made the contestant pool in Jeopardy. No. Oh, I know, but you know, I used to play Jeopardy for money in my dorm. I know that. I also wasn't a man. No, but I played for money in the dorm. I always was. And I made the pool. How do I feel? I feel better since Thursday when the landlord, even though we told him the light switch was broken, when I left, it was dark and I missed the stairs and I fell right on my hip. Yep. It hurts a little, but I had an x-ray, so. Bye.